Good afternoon, everyone. Thank you for attending today's webinar. I am Diana Murray with ASAP Accounting and Payroll, and today we're going to be talking about small business cash flow tips and ways to squeeze every penny from your business. I want to tell you a little bit about ASAP and a little bit about us, because we have a couple people on this call that are not associated with ASAP. So essentially, ASAP Accounting and Payroll started in Telluride, Colorado in 1990. We provide bookkeeping services and help people with their accounting technologies such as QuickBooks and other applications that integrate with QuickBooks. We also do payroll processing in terms of being an outsourced payroll provider for small businesses across Colorado and beyond. And comes along with that, we have some HR support tools and resources as well. And kind of how that fits into kind of this third tier of managed services, you know, we're really on the forefront in terms of finding tools, including applications and software to help you automate and streamline your accounting functions in your business. We're actually up to 28 professionals now in our organization, and we're spread across 3 different offices in Colorado. We service mostly small businesses, and 900 of them actually now across the state and beyond. We do process payrolls in 42 states, so I like to say that at ASAP we're small but mighty. And I will show my video for a second here just to show you that I am a real person. This is not a robot talking. And I've been Vice President of Operations at ASAP, and I'll be going on 12 years this June. So thank you so much for being here today. I'm actually going to stop my video so that I can focus on today's presentation, and we'll go ahead and get started. So I'm going to cover 5 areas to get more out of your cash flow. And I'm going to kind of keep this really high level in terms of I could probably go into a lot of different detail in these 5 areas that I'm going to cover today. But I'm going to kind of hit them all from a high level. And hopefully you can take a little snippet away today in terms of something that's applicable for you. So to kind of start this off, I put this quote up on the screen here, and the message here is really clear and concise. Your company's revenue figures are great to flaunt, but they don't mean much if your cash flow is not stable. Cash truly is king. Profit offers peace of mind, but it doesn't mean that you're financially sound, and really only stable cash flow is a measurement of your true success. So I thought this was a good quote to kick off today's presentation. And another example of this is companies with ample cash reserves can weather storms better than those who have poor cash management. So I put a cartoon of GM on the screen here because General Motors ran out of cash and had to declare bankruptcy years ago. On the flip side of that, we have companies like Google that operated for 9 years before they made their first profit. And that's because they had access to cash. So this is a true example that cash is more important than profit. So we're going to talk about these 5 areas: accounts receivable, expenses, ways to streamline, raising prices and building value into your pricing models, and forecasting and reporting. So kind of diving into here, we're going to start with accounts receivable and how this area directly impacts your cash flow. So in terms of ways to tighten accounts receivable, you can collect on overdue accounts. So, you know, you've done the work. Now it's time to collect the money. And you want to do it with as shortest terms as possible. So whether that's due on receipt, if you're a retail or restaurant operation, typically you're using a point of sale system. So that's going to happen immediately. But if you're in the professional services realm, you still want to limit those terms. So think about net 10, net 15, or even due on receipt. So do away with those kind of net 30, net 45 in terms of collecting on those payments. Another tool is to offer incentives for your customers to pay you quickly. And this might include offering incentives for your customers to pay you through an ACH or direct deposit, or in our world, we call that an e-payment. So how can you incentivize customers to pay you faster? And what tools do you have in place to do that as well? And we're going to talk a little bit about that as we get into streamlining your accounting. And so what happens if they don't pay? Do you have a collections process or policy in place for how you continue to collect on that money? So these are equally important. And then finally, don't forget to write off those old balances. So continue to reconcile your accounts receivable, and don't forget to write off old balances. And write them off, but still make the best attempt to collect on them. So, don't necessarily write them off every month. I'm talking about when you're doing your tax preparation and you have things that have been outstanding for more than 12 months or even 6 months, depending on your industry. So you can consult with your CPA in terms of writing off those balances, but definitely get them off of your balance sheet. So another thing to think about in terms of receivables is the role of a purchaser versus the role of a seller. And sometimes this can have opposites or conflicting goals. So the goals of the receivables end is that you want to limit or minimize, and you want to have those customers pay at the time of purchase or in the shortest terms possible, like we just talked about. However, if you're on the purchasing side, you want to buy the item and pay for it at the most lengthy terms you can get so that you can hold on to your cash. So it's important just to understand what side of the coin you are on, and that you can actually flip sides depending on what you're doing. So you could even be the same businesses, and you have that purchasing role, and you also have the seller role. So an example of this is, a restaurant wants to buy food with credit terms with their suppliers and their food conveyors. They want to sell the food before they pay for it, so that they hold on to that cash, they sell up their food, and then they're able to pay the vendor. If you were on the seller side of that, or the vendor, the food supplier who's trying to deliver that food, you want to actually be collecting that payment on delivery and getting that cash up front. So you can see that sometimes these actually conflict one another. And so it's really important to understand that in each situation, each accounts receivable and accounts payable scenario can be unique. And again, you can be on conflicting sides. So our second area, we're going to talk about expenses and accounts payable and ways to control your spending. And I'm a big fan of quotes, so I threw another quote up here. And, I really feel like if Emerson were alive today, he'd probably have one of the best Twitter accounts and the highest number of followers instead of like Ariana Grande, whoever's leading the charge right now. But I really feel like this quote really hits the nail on the head in terms of the importance of monitoring expenses. So it's really applicable in the importance of cash flow and what we're talking about today, because the importance here is monitoring your company's capital, your company's cash, in a skilled and deliberate manner. So kind of getting into the weeds here, there are a number of ways that you can control your spending and monitor your spending. So kind of an obvious one that I think it might be obvious but not necessarily true in practice is the idea of creating a budget and estimate what your income might be and your expenses, but track it regularly. So don't just create a budget and then come back the next year and create a budget. You should be looking at that budget versus actual every month as regularly as you need to, and adjust it. We realize that a budget is like your best case, your best guess. But really try to adjust your practices based on that information. What is happening to cause some overspending or high costs in certain areas. Monitor your debt and liabilities. Who do you owe money to? This can be a baseline for how much money you need to bring in just to sustain your basic liabilities. So, again, kind of to break that down, rents, utilities, mortgages, all of those things can be the foundation for creating that budget and what is the minimum amount of income that you need to bring in to offset those basic liabilities, and then create some goals around that. So how you can build on that, how you can improve on that. So from there, you can anticipate your expenses. And also what I threw up here is really limit your borrowing. So don't take on a lot of debt. Borrow as a last resort. And really, you want to try to find alternatives to fill in those holes. So, for an example of that, for a retail store, is having a flash sale. Like, what do you have that's kind of dead inventory that you can sell off to kind of cover those periods where you're short on cash? Getting rid of dead weight or non-revenue generating services. If you're in the professional services, they say that, 20% of your clients are covering 80% of your revenue. So kind of look at that 80-20 rule and what kind of services are not producing high revenue, and can you eliminate those services or shift them around, or as we'll talk about in a minute, can you raise prices? So another thing to avoid here is buying long-term assets with short-term debt. So this is a true drain on cash flow. So an example of this is if you're going to buy a long-term asset, such as like a big piece of equipment, get long-term financing to pay alongside with the life cycle of that asset. House, a car is a good example of this because we're paying it off over a longer period of time instead of buying a car with a credit card. So again, that's a huge drain on cash flow in terms of buying long-term assets with short-term debt. At this point, I'm happy to answer questions as we go. So I did want to remind our listeners to use the Q&A box. I am self-monitoring the webinar today, but I'm happy to kind of pause and take a break and see if there's any questions as we go. We'll also have time for questions at the end, so feel free to chime in. And so the next area we're going to talk about is streamlining your accounting activities. So accounts payable and accounts receivable, as we just covered, kind of go hand in hand, and therefore should be monitored closely and monitored together. And so what are some ways that you can kind of monitor your accounting more efficiently? It probably starts with good processes and procedures, but there are also a number of tools that can actually help you streamline those processes. Here at ASAP, we're big proponents of QuickBooks and QuickBooks Online specifically, because there's a lot of efficiency gains with the online version of QuickBooks. But in addition to that, there are applications that integrate with desktop and online that can really help with payables and receivables. One of these examples is Bill.com. So if you have a very payables intensive organization, you have a lot of paper shuffling, and what I say is traditionally going from desk to desk, we promote a system called Bill.com, which integrates directly with QuickBooks. But this is actually a payables process workflow system that allows you to, make the payables process paperless, but also organize your approval workflow through this system. So if you have, say, an administrative assistant who might be opening the mail and sorting it for processing, and then that person can scan it into Bill.com, and you have somebody else, whether it be ASAP or a bookkeeper or an accountant, would then go and code and enter those transactions and then route them for approval. And at the same time, you're always attached to your source documents. So you're always seeing the actual utility bill or the actual food vendor bill within the system. And then the cool thing is it has payment processing built into it. So I like to say that Bill.com is similar to like the consumer bank bill pay features with your bank, but it's built for business. So it's going to integrate directly with QuickBooks and provide a lot of automation and paperless options along with it. So it's truly going to take what used to be like a 10-step process, paper shuffling, into a few steps and a few clicks. Another application that I like to throw out there in terms of managing credit card receipts or debit card receipts, you know, we are in a world of buying everything on cards, and the same goes for business too. We want to get those points and those free trips. And so those receipts tend to be a mess, to put it simply, to put it nicely rather. You know, gone are really the days of shoebox accounting. And so Receipt Bank is a great application where you can just snap a picture of your receipt and then toss that receipt in the trash. Once you snap the picture, it goes into the Receipt Bank inbox on the back end, which then gets, make sure it gets reviewed and coded to the right area. And again, it's integrated directly with QuickBooks. So it's pulling in your chart of accounts, it's remembering the last time you coded it somewhere. And so it's got, you know, accounting software in general in the last 5 years has really gotten to be smart in the way of having smart technology, optimal character recognition, memory, kind of a virtual assistant in a way of remembering what you did last time and assuming you might do the same thing, but prompting you to review it. So there are some great tools out there that can really help streamline accounting activities. And this happens to be an area that ASCP really specializes in, so definitely hit us up if you have any questions there. We would love to be a resource for you. And really, I think, you know, I put outsource on here, and that might be obvious in terms of what ASCP provides, but at the same time, I always want to stipulate to people that even though you might outsource your accounting, or you might be looking to outsource your accounting, accounting should never be completely off your plate. So you should never hand away the keys to your QuickBooks file or to your bank account. I hope you're not doing that, but don't ever hand over the keys to your bookkeeper or accountant. You should take responsibility in knowing your way around QuickBooks, how to run reports, how to interpret those reports. Sometimes that can be a big one as well. If you don't understand it, definitely outsource and get some help, but you should have a basic understanding so that you can spot some things, or, you know, horror stories if I don't even know the password to my QuickBooks file and that person's now gone. Well, there went your data, and there went your financials, and there went your scorecard. So it's really important. I always stipulate it's nice to outsource because you do what you do best, but don't give away the keys. Okay, moving on to number 4. We're going to talk about raising prices, and specifically here, I want to talk about building value into your pricing model. So, you know, obviously some things to think about here is how do you defer from your competition? You know, are you offering something unique and different, something creative, and how are you pricing that? You know, is it a simplified pricing model? Is it a pay by the hour model, which is kind of going away in terms of pricing models? Do you have prefix packages? Do you have subscriptions? Is it pretty cut and dry in terms of a product? But in other words, if you are in the professional services realm, consider ditching that hourly rate and coming up with more creative ways to build value into the services that you're delivering. And really, one of the examples that I like to bring up, I think from the consumer perspective too, is a shoe store. So, I mean, everything is shopping online these days. I could go to Amazon, I could go to Zappos and buy a pair of shoes. So why would I go to the store next door to buy shoes if it's going to be the same price or sometimes even higher because I'm having to pay local taxes? So what is the value in there in what you're providing to incentivize me to come in? And one of the jokes that I like to say in terms of a shoe store is, you know, an idea, maybe this is my marketing brain, but could you give away a free foot massage with a shoe purchase? So could you take, a few minutes? Then you're building value into what you're delivering me, and I am probably going to come in and purchase shoes from you if you're going to give me a 5-minute foot massage. So that's just a very basic example of how you can build value into what you're doing to make yourself more competitive than your competitors and more valuable, and to want people to come in and visit you. And how can you simplify your pricing? Can you raise prices on some of the services that customers might buy regardless of price? So if you have a really valuable service or a valuable product, are they willing to pay more? And have you tested that? Have you tried raising prices? Another option is to consider bundling services, and I kind of just alluded to that in terms of the foot massage, but how can you give that higher perceived value? Value pricing in general is kind of a new strategy in the realm of pricing, and it's really looking at pricing in terms of getting away from the simple markup of your cost or your personnel, and it really taps into the perceived value of the buyer and pricing that, as well as structuring pricing levels. So maybe you have a 3-tier option. And when you do this, you really tap into the psychological buying decision process. So I could talk about this for a long time. It's definitely an area I enjoy talking about. But really the tip here is to think about the value that you deliver and structure your pricing options to tap into those perceptions. And you may just end up with folks choosing a higher level of package. Say if you introduce kind of a 3-level or a 4-level or even an 8-level, when you tap into the buyer making that decision, instead of just giving a black and white price, you really tap into the psychological area of buying. So an example of this, well, kind of another consumer example, is Starbucks. We're all willing to pay what Starbucks charges, probably perhaps because of the experience or the quality or the fair trade coffee, but they have done a great job at having that higher price and getting people to pay for that because of their perception of the value that they're getting. Another example of this might be, so say your choice between a Prius being like the super low package and a Lamborghini being the super high package. Well, I know I can't afford the Lamborghini, and I'm not sure if I want to go as low as the Prius. So there's a bunch of in-between zones where you can really get creative with your pricing. So just food for thought there. So the last area I want to talk about is forecasting and specifically reporting. And I throw another quote up here. And, really new businesses come and go, but cash flow dictates whether or not you'll be in operation long enough to see your efforts come to fruition. So to put it even more simply, profitability is your food, but cash is your blood and your livelihood of your business. So in order to look ahead, you really have to see where you've been. And cash flow forecasting really lets you look at the factors that are affecting your cash flow, like accounts receivable and accounts payable. But really, the act of reporting and forecasting is so you can see patterns and perhaps anticipate those patterns, or maybe even prevent those areas of gaps. So gaps in your cash flow. Richard Branson is the quote up here, and he was an entrepreneur from an early age. He went on to find Virgin Records, Virgin Airlines, a train system. He now has Virgin Galactic, which is a space exploration. So, he's a true entrepreneur at heart. But if he didn't have good cash flow, none of this would have come to fruition. So it's really important to develop and monitor your cash flow and understand those financial reports that come into play. So in terms of reports, I'm going to talk less about, say, a profit and loss and a balance sheet, and more about a cash flow statement. So a cash flow statement is an analysis that shows you how much cash is moving in and out of a business during a given period of time. So depending on what parameters you're running your cash flow statement will depend on what you're going to see. And so it's going to pull both from and supplements the information that's in your balance sheet and profit and loss. So that's another standalone report here. And predictions are an important element of understanding your cash flow over time. So for example, do you have seasonality? You know, are you in an area like Aspen or Telluride where we have these big shoulder seasons that practically shut down our town? So how are you prepared for those shoulder seasons? Are you prepared to kind of fill in those gaps? And if you are an established business there, you probably are by this stage. But if you're looking to open a business there, these are some important predictions to keep in mind. Do you have lean periods where you need to call on reserves? Those off seasons are a good example of that. So here we have a statement of cash flows report that comes out of QuickBooks. And this report, in all honesty, kind of is a little bit overwhelming, I feel like, from a layman's perspective. And so I'm actually going to go over an Excel version as well that's a bit more simplified. But in terms of QuickBooks, this statement covers three main areas. So you have your operating activities, how much cash you made or spent to produce the goods and services that you sold. Second, you have your investment activities, how much cash you used or made through buying and selling your capital investments. This would be like land and equipment. And then you have your financing activities, how much cash flowed in and out, and how is this related to business loans and other funding transactions. So this is a sample statement of cash flows out of QuickBooks. It's actually out of their QuickBooks sample company, so it doesn't have a bunch of meaty information here, but just gives you an example of what QuickBooks can do in terms of a cash flow statement. Now again, I kind of find the QuickBooks one a little bit daunting, and so here's an example of a simple working capital worksheet prepared in Excel. And we do this for a lot of our clients just because our clients understand it a little bit better than the QuickBooks statement of cash flows. So here at the top, we have the cash in the bank. What's the balance in the bank? Less your accounts payable. So what's your accounts payable liability? Who do you owe money to? And then adding back in your receivables. Who owes you money and when's that coming in? Less your payroll. So what do you know, payroll is coming this Friday, so you want to make sure you factor that in. Less any credit card liability that you have, and less any long-term debt payments. And at the end of the day, that should be your working capital. So this could be a good tool in terms of a very simplified cash flow worksheet. We do it weekly for some of our clients. And again, it's really simple in terms of, okay, if we sent this to our client, they might really understand this more than, say, if I sent them the statement of cash flows from QuickBooks. So for some of our bookkeepers in the audience, you know, this is a good tool that you can provide for the business owners or managers or even chef in the restaurant that might understand this a lot better than the statement of cash flows from QuickBooks. And if you want, I'm happy to send this to people, so just shoot me an email and let me know. And I'm happy to provide this worksheet. So what does this mean? What does this all mean? And I really think, you know, by monitoring your cash flow and by seeing those patterns and trends, you're going to be able to better predict and prevent challenges that come your way. So if you have a period where your customers aren't paying you fast enough and you can't make payroll on a week, so these are the kind of patterns that if you really monitor your cash flow closely in terms of cash, you might have a better way to get around those challenging situations. So again, that's the same thing when people are late paying you. This all flows into cash flow. And so this is also really important if you are a larger organization and you have different people that might be in charge of receivables and collections, and then you have the people who are spending the money. So maybe a simple weekly cash flow meeting might help you guys come together as a team to make sure there's not these periods of challenge in there. So understanding your cash flow and really gives you insights into the financial strength of your business It can help you find out areas where you can improve, or, you know, it might tell you you're doing exactly the right thing at the time that you're doing it. So I think these areas are really important, and I know I kind of covered them quickly in terms of our 5 areas, but I really wanted to hit kind of high level because I know that we have a lot of people on this call that are from a lot of different business sectors and from a lot of different size companies. And so hopefully you've gotten some kind of tidbit out of what I've presented here today. So again, everyone, thank you for your time today and have a great day.